What if I told you that the most critical indicator for Bitcoin's price isn't on any trading chart you're currently watching? We've all seen the headlines. Bitcoin briefly tops $107,000 before retreating. ETF inflows anemic, market fatigue sets in. These are the symptoms, the fever a patient runs. But they don't tell you about the infection weakening the body from within. The real story, the one that explains why this recovery feels so hollow, so fragile, is written in the silent, unflinching ledger of the blockchain itself. This is not about fear or greed. This is about exhaustion. I want you to do something for me as we dive into this. I want you to forget every preconceived notion you have about why markets move. Forget the TV pundits and the tweet-length analyses. For the next few minutes, I want you to see the crypto ecosystem not as a collection of prices, but as a living, breathing organism. And what we're about to explore is its medical chart, showing clear signs of a prolonged and debilitating sickness. The data I'm going to walk you through is organic, pulled directly from on-chain sources, and it paints a picture that is far more nuanced and far more concerning than a simple correction. So, if you're ready to look beyond the price tag and understand the foundational cracks, hit that subscribe button and let's get started. The first place we need to look is at the behavior of the network's most dedicated participants, the long-term holders. These are the entities, the individuals, the funds that have held through multiple cycles, through brutal winters and euphoric peaks. They are the bedrock of the Bitcoin ecosystem. And right now, the data shows that this bedrock is shifting. On-chain analytics platforms, which track the movement of coins based on when they were last spent, reveal a subtle but persistent trend. The spending activity of long-term holders has been ticking upwards for weeks. This is profoundly significant. These are not the weak hands who panic sell on a 10% dip. These are the stalwarts. When they begin to distribute their coins, even slowly, it signals a fundamental change in conviction. They are the smart money, and they are taking profit not out of panic, but out of calculated assessment that the risk-reward ratio at these elevated levels, even after the recent decline, no longer justifies unwavering diamond-handedness. This isn't a stampede for the exits. It's a quiet, deliberate exodus of the most knowledgeable players. They are selling into what strength remains, providing a constant, distributed supply overhang that caps every rally. Every time the price tries to muster a rebound, it runs into this invisible wall of supply from the very cohort that should be its most fervent believers. This creates a powerful and self-reinforcing dynamic. The market cannot build the momentum needed to inspire new, massive waves of buying, because the confident, long-term capital is, in fact, leaving the building. This is the core of the market fatigue. It's not just a feeling. It's a quantifiable on-chain reality. Now, let's couple that with the second piece of our puzzle, exchange flow dynamics. You've likely heard that Bitcoin is flowing onto exchanges, which is typically a bearish sign. But the story is in the details. The net flow, the difference between inflows and outflows, has been consistently but mildly positive. This is a fatigue-driven seepage I mentioned. It's not a flood of panic, which would be a sharp, massive spike. Instead, it's a steady trickle. This represents a different kind of seller. The weary, the uncertain, the marginally profitable investor who has simply grown tired of the volatility and sees no immediate catalyst for a return to the highs. They are not selling their entire stack. They are lightening their load, testing the waters, and in doing so, they are adding to the constant, grinding sell-side pressure. This creates a market that is constantly heavy. There are no violent crashes, just a slow, gravitational pull downward, interrupted by short squeeze rallies that quickly fizzle because the underlying demand is not there to sustain them. And this brings us to the most misunderstood element, the ETFs. The narrative that tepid ETF inflows are the problem is putting the cart before the horse. The ETFs are not the cause. They are a reflection. They are a gauge of institutional and retail investor appetite. The fact that they only attracted a net of $1 million on a day when traditional markets were rallying on positive political news is a screaming signal. It tells us that the capital allocation decision makers, the wealth managers, the pension funds, they're looking at this exact same on-chain data we are. They see the long-term holders distributing. They see the weary retail investors slowly capitulating. They see a network that is, for the first time in a while, lacking a compelling narrative of scarcity. Why would they allocate significant capital into a market that is showing these fundamental signs of distribution? The ETFs are simply the conduit. The real story is the lack of conviction at the source. The technical breakdown below the 200-day moving average, which the analysts are rightly focused on, is merely the final, visible confirmation of this deeper, on-chain decay. The price broke that critical level because the foundational support from long-term holders had already begun to erode. The chart is just catching up to the reality of the blockchain. So, if the foundation is cracking, where do we go from here? Understanding the disease is only half the battle. The critical next step is diagnosing potential paths to recovery, or conversely, recognizing the signs of more prolonged illness. The market's current state isn't a permanent destination. It's a phase in a larger cycle, and the data we're about to explore will give us the framework to anticipate what comes next. This is where we separate the seasoned investors from the reactive traders. The previous paragraph laid out the undeniable evidence of weakness, but this is where we look for the seeds of future strength or the warning flares of further decline. I need you to stay with me here, because this is the part that will truly empower your decision-making. The same on-chain intelligence that reveals the sell-side pressure also holds the keys to identifying a genuine bottom and the return of sustainable demand. It's all about watching for specific, quantitative shifts in behavior, not just hoping for a green candle on the screen. And before we go any deeper, if this level of analysis is providing you with value you simply can't find anywhere else, then you need to be part of this community. Smash that like button right now, because it tells me you're getting this. And it ensures the YouTube algorithm shows this crucial information to other serious investors who need to see it. Let's start with the most crucial metric for a true recovery, the revitalization of the long-term holder cohort. Remember, their distribution is the core problem. Therefore, the first sign of a genuine structural healing in the market will be the cessation of this spending. We need to see their net position change flip from negative back to neutral, and eventually back to positive accumulation. This won't happen overnight. It will be a process. It will require the price to stabilize in a range that these sophisticated players deem as a new value zone, a process often called reaccumulation. This is where weak hands finally transfer their coins to strong hands at a discounted price. But we are not there yet. Currently, the data shows they are still in the distribution phase, which tells us that, in their view, the risk of further downside still outweighs potential for immediate explosive upside. They are waiting for a better entry, which means lower prices or a much more extended period of sideways consolidation that shakes out the remaining fatigue-driven sellers. We must monitor their wallet addresses closely. The moment their collective balance sheets start growing again, that is the single most powerful buy signal this market can generate, far more important than any single day's ETF flow or a brief technical breakout. The second factor we must watch is the behavior of the short-term holders, the so-called tourists in the crypto ecosystem. Their realized price, the average price at which they acquired their coins, now acts as a formidable resistance level. As the price dances around this level, every move upward is met with selling from those desperate to break even and exit their painful positions. This creates a self-limiting rally environment. For a true breakout to occur, one of two things must happen. Either the market needs to undergo a violent, rapid flush that flings the price so far below this cost basis that these sellers are wiped out, creating a vacuum that allows for a new rally to begin, unencumbered by their overhead supply. Or we need time, a lot of it, a long, boring, grinding consolidation period that slowly allows the short-term holder cohort to be replaced, as their coins are slowly bought by new, more patient entrants or by the returning long-term holders. The current data suggests we are in the latter, more tedious scenario. The market is trying to wear down the sellers through exhaustion, not through a dramatic crash. This is why the price action feels so directionless and fragile. It's a tense standoff between weary sellers and cautious, value-seeking buyers who are not yet convinced of bottom. Finally, we have to talk about the external catalyst, the spark that could ignite the kindling once the structural conditions are right. The ETFs, while currently a reflection of apathy, hold this dual nature. A sustained period of net inflows, even modest ones, coinciding with the on-chain stabilization of the long-term holder base, would be a powerful confirmation of a new bullish regime. It would signal that institutional capital is beginning to see value at these levels, aligning with the renewed conviction of the network's core participants. This confluence of factors, long-term holders accumulating, short-term holders selling pressure being absorbed, and ETF flows turning sustainably positive, is a trifecta we must patiently await. Until then, every rally is suspect. Every push toward resistance is more likely a bull trap than the start of a new leg up. The current struggle is a necessary, albeit painful, cleansing of the market excesses from the previous run-up. It is the ecosystem building a healthier, more resilient foundation for the next cycle. The path forward is not about predicting a specific price tomorrow. It's about vigilantly monitoring these fundamental on-chain shifts. The recovery will not be announced with a single loud bang, but with a series of quiet, data-driven whispers that the attentive investor will hear long before the crowd. So, I'll leave you with this final call to action. This isn't just information, it's a toolkit. Your next move is crucial. Go to those on-chain analytics sites. Look up the metrics we discussed: long-term hold and net position change, exchange net flow, and short-term holder realized price. Start correlating them with the price action you see. Turn this knowledge into your own independent research. And when you see these signals start to align, you'll be ready, not reacting to headlines, but acting on a deep data-driven conviction. If this has changed your perspective on how to navigate this market, let me know in the comments below what was the most impactful insight for you. And of course, subscribe and hit the notification bell, because when those on-chain signals finally flash green, you can bet I'll be here to break it down for you first.